Hello and welcome to another episode of Fintech Focus TV with me, Toby. Today we are back out in the United States of America. It is my great pleasure to bring to you Zack Nagelberg of Derivative Path. Zack, how are you?
Doing well, Toby. Doing well. How are you, sir?
Very good indeed. Thank you. Very good indeed. Listen, loved our little preamble and finding out a little bit more about the what's been a pretty stellar year for you guys. Despite everything that's been going on, there is so much that we're going to be getting into and talking about in the near future. The business itself couldn't be in a more exciting position from everything you've just been telling me about. So I'm itching to let everyone know about it. Before we do that and get into the reads of the story, will you tell us a little bit about what Derivative Path does and your role as Chief Growth Officer as well?
Sure, happy to. So Derivative Path is looking to democratize access to derivatives and capital markets products for what we're calling Main Street. So in other words, we feel there's this growing need to de-risk for companies, whether it's financial risk, interest rate risk, foreign exchange risk, or operational risks, meaning they're running things out of spreadsheets, right? And so we feel that historically there's been a massive gap in terms of what's available from a technology standpoint, as well as a human kind of people infrastructure standpoint, between what kind of Wall Street and kind of the largest market participants have access to relative to what Main Street and kind of our core client base has access to. And we're seeking to kind of level the playing field and provide kind of a unified platform for their access to these products.
And there's enormous hunger for that sort of thing at the moment, right? Isn't there? Because more and more of the companies I'm talking to who've been attracting investment or growing specifically at the moment have been, I guess, really focused on capital markets finance in general, looking to have a much more level playing field, looking to have a, for want of a less woolly sort of phrase, a sort of fairer way of doing business. Is that something which you guys have really benefited from?
We have. I mean, we've grown revenue top line about 80% in 2020. We've doubled our client count since 2019. So we're certainly experiencing a lot of that growth. Absolutely.
Yeah, no, it's great to see. And look, speaking of growth, your role there is Chief Growth Officer of the C-suite. I always love that title. And it's not everyone who's working with that. Give me the scale of what you're doing, because growth is either revenue or it's strategically or potentially headcount or wherever it goes. What as Chief Growth Officer, talk us through what you're responsible for.
Sure. Yeah, so I've been with the company since we launched about 8 years ago, May of 2013. So the title has changed recently to this Chief Growth Officer, but as founders, we like to joke, we do everything, and we've been doing that since day one. Whether it was coming up with the company name, to figuring out what the logo is going to look like, the website, picking up the trash, to selling, the widget, the prototype. So all the above, and so. There's a lot of that still. We're very much entrepreneurial, and it's, all hands on deck. Obviously, as we've grown, it's become a little bit more structured. And, when I think about growth, it's really, we've got kind of our core business, which was interest rate derivative platform for regional and community banks in the US. And then we have everything else, which is all of our exciting growth initiatives, whether it's our recent acquisition of Minetics, our expansion into more of your traditional end users of these products. And so I kind of oversee all of the new initiatives from a product standpoint, a sales standpoint, marketing standpoint, et cetera.
Which there seems to be many at the moment, which we'll come on to again in a second. This is, we talked there about this as an interesting area. Look, I think I've spoken a number of times on this show about golden threads, what's sort of unifying some of those interesting and fast growth companies out there at the moment. One of the things has been naturally, and probably no revolution to this comment, but it's been about being in the right sort of marketplaces where there's a genuine need about what we're talking about. The stats I've got in front of me here, and I'll read them, is the market size has 5,300 depository institutions in the US. Now, 800 have between $1 billion and $150 billion in total assets, and 75% of those have hedging needs. Those are some pretty exciting figures for a chief growth officer to be to be looking at in terms of the scale and size of market structure. Tell me a little bit about the market, why it's needed, and where you guys fit in to really helping that out. What's the sort of overarching problem that you're solving, and what's, where does it go with this?
Sure. Yeah. So what we recognized when we launched the company about 8 years ago was that there was a growing need for regional and community banks, specifically at the time, to be able to access the capital markets and derivatives markets in particular. They had inherent interest rate risk by being banks, but oftentimes didn't have the size and scale to have gone and invested significantly in enterprise technology platforms and/or have significant resources internally with experience in these products. They didn't have trading desks in-house. They didn't have legal and compliance specialists. They didn't have derivative accounting professionals on staff. And so we felt like there was a growing need to be able to kind of provide this hedging as a service out of the box solution where we've got the technology purpose built for their needs. And we've also got a seasoned team of professionals that basically become an extension of their team to help them stand up or enhance their capabilities in that space. So that was kind of the initial thesis. And I think the stats you mentioned are spot on, about 5,000 US depositories. Everyone knows the JP Morgans, the Citis of the world, but there's the significant portion of the total banks in the country are community and regional banks. About 5,000 of the 5,000, about 800 plus are between $1 billion and 150 billion in assets. And really, that's where we feel we can add a lot of value, where they're large enough to have meaningful commercial activity that warrants managing this risk using derivatives, but not so large where they've got a homegrown tech system and a fully built out team. So that's the idea. But really where we're at now in our growth is like, okay, that's a meaningful addressable market, but how do we grow that significantly? And the answer is other client segments. Credit unions, non-bank financial institutions, corporates, financial sponsors. How do we make our application and team as widely applicable to those sorts of institutions as it is today to the bank space? And so that's one of the things I'm actively working on now. And we've got a number of exciting initiatives already kind of rolled out and underway.
And some of that comes down to acquisition, right? And you mentioned Monetics earlier on. How did that fit into this master plan?
Yeah. So it happened really organically. We had identified that financial sponsors, private equity firms, whether that's traditional PE or real estate private equity, had a growing need for better access to derivatives technology and services, just like we'd identified in the bank space 8 years ago. But what we're recognizing is, these kind of real money accounts view their derivatives as it relates to their underlying exposures, which in this case is the commercial debt itself. And so we recognized that by only focusing on the derivative and not the underlying debt, there was a bit of a gap in our offering. I think on the flip side, Monetics was a seed stage company. They'd launched in early 2020. They were revenue generating, but hadn't reached similar size and scale as us, of course. But what they were running into was this need from their customers to think about the derivatives piece. They had a debt management platform that was really well designed and well built, but their clients were saying basically the opposite of what we were hearing. Hey, the debt is great, but we want to be able to view our derivatives and manage them all in one place. And so it kind of happened very organically. They reached out to us through a mutual contact and wanted to talk about a potential strategic partnership. And as those conversations escalated, it just became more and more apparent that the optimal structure was just a full-on acquisition. And so things moved pretty quickly and we closed the deal in late March, and we're really excited about the combined offering.
I think that's incredibly insightful, isn't it, to see those sort of things and recognizing on both sides that there's an opportunity here to scale and do things bigger. And I guess that sort of came through from, we were talking beforehand, it was middle of June or middle of the summer last year, June 2020, that you raised your Series B. I'm in awe all the way through of talking to people who've managed to secure Series B funding and above over the course of, and even below, over the course of the last year or so, because there's been so much uncertainty. And trepidation from businesses. I think actually raising that cash, there's got to be something genuinely special and a pitch deck that's got far more substance to it than the cash that has been thrown at fintech businesses for the last couple of years, which has been kind of like a spray and pray sort of approach. For me, the big difference over the course of the last year is people have been getting some pretty big figures together and seeing some fairly large investments for various reasons. Talk to us a little bit about what prompted the timing of that, the process that you went through in it, and why. I won't load too many questions into one particular pass, but I'm always in one particular loaded question. But I'm always interested as to what investors will have seen in the business that really encourages them to put that sort of investment in during a global pandemic that in June 2020 was still very, very much right in the eye of the storm with no real insight into how long, when, etc., etc. That takes great offensive strategy from the investor, but it also means that you've got something which you're obviously very proud of for good reason. Tell me a little bit about that whole process. If you grab any question from the 15 that I've just asked you.
I'll take a stab at it. So you mentioned kind of unique timing, closing in the middle of a pandemic, and I joke we still haven't had our closing dinner yet, so we've been celebrating from afar. But no, look, I think the way it all came together was unique. While it's technically a Series B, it was actually our first outside investment. Prior rounds had all been kind of founder-led and inside. And we're really from our first year of kind of inception. And so we kind of reached an inflection point in 2019 where the business was really starting to take off. We'd been profitable really since our first full year of business. And so it wasn't like some of these other stories you hear of people raising funds in a pandemic and it was kind of out of desperation. For us, the process was fairly drawn out because it wasn't a matter of need and it was about finding the right partner. And I think that actually benefited us quite a bit because by the time we got to diligence, we already knew our investor quite well and they knew us too. So it wasn't as important to have kind of the in-person, face-to-face meetings that you would typically have during a diligence process. There was already a level of, I think, credibility and trust established on both sides. And so, what wasn't easy, like most diligence processes, a lot to do and even more challenging remote, but I think there was conviction on both sides that it was the right deal to do, and we were able to get it done in June, and we've been kind of off to the races since, which has also been unique in this day and age. I mean, we've added a ton of people learning how to interview and hire in these conditions, especially for positions that are as strategically important as some of the ones we've filled. Has certainly been an interesting process.
Yeah, you've not, as you say, you've significantly increased the headcount of the business. Again, many of those you won't have met, which is, I think, is a cultural challenge at various different times. You've acquired a business, which again, without that sort of face-to-face elements is challenging, and you've got all the integration aspects that come with that as well. Tell me about some of the lessons that you've taken that have worked really well for you within that, because we're all learning as we go along with this, and we're all sort of seeing things. What are some of the things that work really well for you guys in overcoming the challenges that have presented themselves in the last year or so?
Sure. Yeah, so I mean, we consider ourselves a tech-forward firm, but to be honest, pre-pandemic, we weren't really utilizing tools like Zoom. We didn't really need to. We were in an office and having most meetings face-to-face. And so I think one of the challenges has been not able to have those whiteboard strategy sessions and get the group together and really collaborate. But I must say, some of these online tools really are a great kind of temporary replacement. And I find that there's really just no substitute for time, even though it feels a little bit more difficult to sit in front of your computer all day and not, we all want to be doing these things in person, but the way we've been able to keep moving forward is putting in the time, get to know people, even if it's remote, and make sure your strategic vision is aligned. And then once you reach consensus there, then don't be afraid to go execute, because the clock isn't stopping for any of us, right? We've got lofty growth ambitions, and we can't afford to say, well, when the pandemic's over, that's when we'll go work on all these goals that we'd already identified. I mean, if anything, we've had to move quicker than ever before. And so you just find a way to get it done, I guess.
That's, for me, a very interesting fact there. You talk about that sort of offensive mindset. We've seen it for some time of people who sit there and have used this time to sort of duck from the storm, to to sort of say, let's if I want a better expression, a more suitable and less more empathetic word, so survive the whole the piece, and then start to sort of grow afterwards. But there's been a massive opportunities for people to turn the negative into a positive, make their business stronger from it, and really thrive through that, and get play offense as opposed to defense within it. What prompted you? What gave you guys the confidence with so much uncertainty to be able to do that?
Yeah, I mean, I think it's just conviction on the strategy. And I think the pandemic helped create the time to think through that and refine that strategy. I think before, as a fast growing startup, it's all about sales. And I was on the road a lot, as were most of my colleagues. And so while that is offensive, you're trying to acquire new clients, it's also kind of makes you a little bit more reactionary, because you don't have the time to actually sit and whiteboard and come up with not only how we're going to meet our budget this year, but what do the next 3 to 5 years look like. And I think we've gotten much better about doing that, partly because we're now institutionally backed and we have to, but also because we see the merit in doing that. And so I think we've sat down, we've said, okay, how are we going to get from point A to point B? We have lofty goals in mind in terms of where we want to get from a revenue standpoint, enterprise value standpoint. And so once you come up with how you're going to get there, you've got to go execute. And so we feel conviction that the new businesses we've entered are our path to getting there.
You also mentioned just before about the investment you received. Their sort of thought process behind doing it as well. Talk to me about that part, that partnering aspect. You wanted to make sure you did the due diligence to find the right partner for you who matched your ambitions. We know the statistics around series, and we know that there's companies that rush that for the wrong reasons, and people do it for the right reasons and then get the right partner for it who are tuned into where they go. That to me is one of the great pieces towards, or one of the great signs of a successful partnership within it. But that sort of, whenever you think about investment, it's about the company making the decision on who they invest into, as opposed to the company who are being invested into making a decision about their partner for that. Sometimes from desperation, sometimes it's been the right sort of chemistry or choice. Tell me about some of your views about why you chose the partner you did, and how you guys came up with that sort of solution, and I guess the beauty parade that happened therein.
Sure. Yeah, and look, I say this extremely modestly, but the cash itself was kind of commoditized. It's certainly coming in handy now to fuel some of these growth initiatives, but at the time, it was really about who's the right partner to help us scale the organization. The founding team felt very confident in our abilities to continue to grow organically, but not necessarily to take the company to the heights that we want to. And so, that's kind of where the conviction came that we need to find a partner. And then when it came to selecting the right one, what really impressed us about FTV is, they've got deep industry expertise, not just in financial services, but also technology, right? And we're kind of a hybrid of both and at the forefront of both, and felt like they understood the business quickly and quite well, and that they had really great experience with other companies that not necessarily do exactly what we do, but are in kind of tangential segments and businesses. And watching the success that those companies have had, we felt like this is a really great fit.
Absolutely. I think it's really interesting, isn't it, about how that all gets put together. You've mentioned a few times now about sort of ambition and drive and growth of the business, and I think you probably say it's a lofty set of ambitions that you've got as a team. Let's look forward a little bit. Tell me about what's really exciting. Tell me about where you want to go, where you're at the moment. So headcount at the moment is roughly?
It's close to 50.
Close to 50. So, and it's gone through that sort of rapid expansion after a sort of organic growth period so far. Tell me about what the next few years looks like, and what's really exciting about where you're heading.
Sure. So we've got this fantastic, valuable underlying core client base, which are the regional and community banks that we talked about. So part of the growth strategy is to take our product and expand it into additional asset classes and verticals that would also benefit our core customer. So one example would be, interest rate derivatives were really what we built the company around. But one of our newer initiatives is foreign exchange, where we also feel there's a growing need for regional and community banks to have access to better sources of liquidity, better technology, better processes to manage this business. And so that's a big effort for us, is kind of cross-selling or educating our client base on this FX capability as well. I think commodities are another asset class that's exciting to us. It's maybe not, there are not as many banks that have a need, but the ones that have it are they need it. And especially when we've seen the volatility in commodity markets over the last couple of years, there's direct evidence of why that might be the case. And so that's another asset class that we kind of like in the not too distant future. And then in addition to asset class expansion, the more you broaden your capabilities, the more client segments you become relevant to. And so in addition to regional and community banks, credit unions, we're really excited about our push into financial sponsors. And once you start talking to sponsors, you get access to their underlying portfolio companies, which are traditional kind of corporates, right? So, and that's where it gets exciting from just a total addressable market standpoint. I mean, some folks will probably listen and say, man, 1,000 banks in kind of the core market, that doesn't sound all that sexy when you think about B2C or other B2B businesses. But the sheer number of commercial borrowers, corporates outside the core bank space, it grows significantly. And so that's what we're really excited about. But we're also approaching those markets methodically. We don't want to be a one-stop fits all, for everybody. We think that we need to be very methodical and purpose-built as we approach those segments, much in the same way we were in the bank space. So we're spending a lot of time on product as well.
There's an interesting thing about democratizing marketplaces, isn't it? Particularly when you're there and you're seeing the sort of rise of the little guy, as we talk about with it, and that comes with it, the sort of threat of institutions not necessarily being the happiest about that side of things, and that comes with either the when we look at fintech and its disruption of the financial markets, the capital markets, there's been two schools of thoughts about the response from it. One of which is the the institutions themselves will either sort of partner and absorb the businesses within that, and we've seen that with sort of fairly strong, entrepreneurial spirits of the more entrepreneurial banks. I'm thinking of your Cities as a very strong example. You look at Barclays and everything they've been doing with Rise and the accelerators, etc. Or it's been combative and saying, right, let's squash this and play hardball with it all. With a business with the scale and opportunity of yours to change a market, what sort of threat does should the institutions have from how they're working with you, or should that be a threat, or are you seeing encouragement or acceptance on their side? What's the enterprise view of what derivative path is doing at the moment?
Yeah, I would say more the latter, because look, spreads were already coming in long before we started our company as a result of Dodd-Frank, for example. All dealers need to disclose mid-market anyway. I think there's just much more awareness of kind of these end users around pricing and making sure they're getting good execution. So that's not really our primary role. And I think I would argue that we're actually, by providing access to more clients, to allow them better tools to trade with these large banks, it's actually creating more business for them on a pure volume basis. So maybe spreads are coming in because that was happening organically anyway, but volume is ideally picking up to kind of counter that. And I think we talk to the large banks all the time. I think they view us almost as a client, as an aggregator of their clients, right? Because instead of them having to go out and sell and set up trading documentation to 150 banks today, we're bringing them, that bank population and kind of making setting up those relationships a little bit more efficient. So I don't think they view it as a huge threat.
In terms of the last 12 months in particular, there's been companies there who've been, everyone's been through the ringer a little bit and has their own story and their own successes and failures and such. Like, if you could sort of summarize some of the lessons which have allowed you as a business to probably go through its, again, arguably, but without knowing the intimate details of it all, but probably its best period of since launching in 2013. what are some of the sort of key takeaways that you take from why the company's been managed to be so successful in so trying different so trying circumstances? What are some of the things you guys have really got right over the last year or so?
Yeah, I mean, I think it's being very diligent about product market fit, right? We didn't launch a company and then decide, okay, what are we going to now go do? I think we all left. I mean, I was at Wells Fargo on their interest rate derivative sales desk prior to launching Derivative Path. And I think, me and the rest of the co-founding team left because we had conviction that there was a gap in the market and an underserved aspect of the market that we could really help. And so it was being thoughtful around the business plan, the strategy, and then looking at it as various legs of the race, right? That was phase one, is let's get this off the ground. Let's create some brand awareness in our very specific niche. And once we've kind of accomplished that and have reached a certain size and scale, and our technology has scaled accordingly, how do we make ourselves relevant to a wider audience? And I think just having that conviction and kind of forward-looking strategy has been really helpful, because we've just stayed true to that despite changes in market environment and temporary headwinds due to the pandemic and other things like that. That's fine. Big picture, things still very much look the same. In fact, there's even potentially an acceleration of the adoption of our technology and services as folks have a need to kind of digitize and experience that digital revolution maybe quicker than they would on their own device, if left to their own devices. Having a good business plan and then being able to execute when opportunities present themselves, and just staying kind of following the path despite kind of the headwinds that'll inevitably come up.
Yeah, bold and brave sort of mindset, I think, has characterized so many of the companies that have really managed to navigate these storms in the best possible way. I can't believe how quickly this has gone. I say that a lot on these shows, but it's generally sort of flown by, and there's so many different things I want to sort of dive into a little bit more, and maybe that's for another show, Zack. But let's finish with a couple of final questions from me. The first one would be that there's a lot of people who watch this in all different sorts of areas and geographies and company backgrounds. Who would be really interesting for you to be speaking to? Who can you help at the moment, and who should be reaching out to you? Both in terms of people who are watching it who want to join the rocket ship, or people who are watching this and are saying that this could really help my business at the moment. The second thing I want to ask you behind that is how they get in touch with you. What's the best way to reach out to you to find out more?
Sure. Yeah, look, I love that question. We are looking for entrepreneurs. We're looking for folks who understand our business, but also who are just fintechs at heart, right? We're looking for people that want to innovate, want to build, that are really excited about the opportunity. And so we definitely have some interesting roles on the team that we're looking to fill, both from a product standpoint as well as from a sales and engineering standpoint. So yeah, I would encourage folks who are excited about anything we've covered today and looking to democratize access to derivatives and capital markets, would love to chat. From a client standpoint, yeah, look, I mean, any banks out there looking to digitize, looking to enhance their capital markets capabilities, any financial sponsors, corporates, real estate customers, basically any consumer of debt or derivatives, come talk to us. We're really excited about what we're building and what we've built, and think we have something that's kind of purpose built for you. In terms of best way to reach out, probably LinkedIn, or I don't know if this is the right forum, but happy to give my email address and our broader team contact, and would love to have a conversation.
Superb. Well, we can tag you in on LinkedIn when we release this, and we'll make sure that people reach out to you for anyone who we do. Look, I love talking about businesses like yours that have been on such an incredible ride over the last year or so. I think it's really inspiring to see that sort of thing. And I think, if you unpick the bones of everything we've spoken about, the courage of having a strategy which solves a problem that needs to be solved and adds real value to a marketplace, and that those sort of themes come time and time again, backed by good people who are able to sort of illustrate and showcase what that means, which is clearly what you would have had to have done back in June last year when you were raising those funds. And I think it's tremendously exciting. So Zack, it's been an absolute pleasure. I really appreciate you taking the time and giving us that sort of story, and I look forward to finding out a lot more about it in the future. But thank you so much for joining us today. Really appreciate it.
My pleasure, Toby. Thanks for the time.
No problem at all. And listen, thank you all for watching. We love having you watching the show. We hope that you've had as much value as I've taken from this over the course of today as well. We will see you soon on another episode of Fintech Focus TV. Thank you so much for watching.